Hey, what's up, everyone? It's Josh Flores from Wall Street Saturday. I just want to thank you guys for checking out the video this week. If you can, please support the channel by liking the video and subscribing. And I just want to inform everybody that everyone on this video are not financial advisors, nor anyone's financial advisors. Anything that's said or seen on the show is strictly for educational purposes only. With that being said, please enjoy the show.
Hey, good morning, everyone. It is August 27th, and not just any Saturday, it is a Wall Street Saturday. Today, we're going to be trying something a little bit new by reacting to the Fed chairman's comments at Jackson Hole. In other words, Jay Powell's comments on the economy and what might be ahead for raising interest rates. But before all of that, introductions. I'm Joshua Trusty.
Misael Gonzalez.
And I'm Josh Flores. Before we get too far ahead, this channel, we love to pray. We love stocks, but we also love the Lord. And so with that being said, let's just go ahead and pray here. Dear Father, we just thank you for another day that we get to come together. We just as friends, as brothers of Christ. We just thank you for this opportunity that we get to speak about just the way that you're making this world work, really, and just the economy and just blessing us with employment, being able to have this moment here. And it's in your holy name we pray. Amen.
Amen.
Oh, perfect. Yeah. Amen. So I am actually going to share my screen and I'll start playing it here. Let me know if you guys have any issues with this, but I'm just going to start it from
Esther, thank you very much for the opportunity to speak here today. At past Jackson Hole conferences, I have discussed broad topics, such as the ever-changing structure of the economy and the challenges of conducting monetary policy under high uncertainty. Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance.
We have to tell everyone that we just switched to Verizon's new Welcome Unlimited plan.
Interesting. I think in the very beginning, he doesn't really talk much about anything new. It's just, we know inflation's bad. If you want, you can just also mute the commercial while I talk. Yeah, inflation's bad, and people who are not economically privileged do bear a significant portion of the burden.
Reducing inflation.
What's up?
Likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
I paused it because this has just been my urge the whole time, right? Been saying that something's got to happen in the labor market, man. Obviously, I think he's talking about I'll just say a recession, right? I think he's bringing it on. Slow moving into it, right? Soft.
Yeah, what else would you call a situation in which there's now pain to households and businesses, and the labor market has softened where it used to be very strong? That's almost like you're painting a picture of a recession without saying the R word.
Yeah, I don't know what it is. He just told us that he was going to be more direct, but he's still beating around the bush, right?
True. Yeah, I think he just wants to scare the market a little bit without totally frightening it and sending it into a frenzy. Although, the market was down by 3% yesterday anyway. So
I was gonna say, man,
how much worse could it have been?
These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. The U.S. economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome.
I mean, he's complaining about like high inflation, which we knew was going to be a problem in September, but waited until much later in order to intervene. I mean, I don't know. It's interesting to hear him portray the state of affairs as negative when he also had the ability to do something about it much earlier. But, you know, live and learn, I suppose.
Yeah, we're trying to have our cake and eat it too, right?
Yeah.
Yeah, I mean, I think that there's definitely a war for talent, right? Like he's kind of mentioning, right? The demand for workers is like, how do you say it? The demand for workers is far exceeding the supply.
Yeah, that's what he said.
Yeah, so I mean, I just think that I think it goes back to the paychecks. I mean, that's why we're raising the interest rates, right? Because all these high costs for these employees is getting too high, and they're passing those costs on to the consumers, like you and me, right? So that's and that's essentially what I think he's trying to say, man. I think the reason he's trying to incentivize these companies to chill out, you know?
Right. And I guess there's also the concern that inflation will be forever. Like the prices will never go back down. Like maybe year over year, it's going to stabilize. But if like inflation is allowed to persist, so I think these higher prices will just continue onward.
And I mean, historically, inflation is typically like around 3%, you know? So getting it around 2%, that's a pretty aggressive move, you know?
Yeah.
A single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down.
Talking about last month.
So we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting.
Yeah, man, I wish I would have pulled it up. But you know when the next meeting is supposed to be?
I believe that one is in September. So that's going to be based on like 2 months of data. So July and August data.
Mm-hmm. Yeah, so I guess that's why everybody was kind of freaking out this past Friday, right? It's because they're just now pricing in this like crazy interest rate hike. Everybody thought that we were hopefully going to slow down on this, but now we're looking like we can see potentially even another 75 basis points here, right?
Yeah, I was hoping for 50, but it looks like 75 is on the way. Well, pending, of course, on like this month's results.
Did he say that it was at 2.25 or 2.5 right now? Did I misunderstand that, or?
I think he mentioned something else was like 2.5.
Oh yeah.
I don't recall exactly what though.
Yeah, I forgot what their goal was for the year. Do you remember they had a percentage that they wanted to reach? I wanted to say that it was 3% or maybe 2%.
Oh, for inflation, like their goal is has generally been 2%.
Well, I mean, the interest rate goal, right? Because they were supposed to raise it a few more times. I thought they were only supposed to raise it 1 more whole percent by the end of this year. So if they raise 75,
I don't know.
Points, yeah.
We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023. Participants will update their projections at the September meeting.
YouTube is killing it with the ads.
Yeah,
But
everybody's
it's
trying
just
to find,
go ahead.
I was gonna say everybody's trying to find new sources of income, you know.
Right.
Here we go with an
Getting ready
8-minute
for the recession.
already 3 different ads in the 8-minute video have 4 minutes. Right. I'm gonna play.
Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on 3 important lessons that I'll highlight. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. It may seem strange now that central bankers and others once needed convincing on these 2 fronts. But as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the Great Inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. It is true that the current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses, and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions.
That's what happened here, right?
As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself, so part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. One useful insight into how actual inflation may affect expectations about its future path is based in the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions. When inflation is low and stable, they are freer to focus their attention elsewhere. Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions. Of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay, as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation. and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
There you have it, folks. The iron fist approach is going to be used.
Yeah. Thanks.
We're going to beat inflation to death.
Yeah. So this might be a little bit of a longer video, but I think that warrants like a small discussion. You know, I think, man, I would be so frustrated if Jerome Powell was like my boss and I was working for the Fed. I mean, I think it's pretty clear just like what he's trying to say. He's trying to basically blame high wages on inflation, but it's like, you know what I mean? It's kind of like this overlapping. Again, he's not being direct, like he mentioned. That's just my point of view. But I'm fully convinced, man, it's the labor market's fault. You know, it's the company's fault. You know, yeah, sure, there was like a little bit of a constraint in supply, but you know, I think that was a result of COVID. But I think now I don't think it's as big of an issue as it was 2 years ago. You know,
right?
But that's just my point of view of things. You know.
Misael, do you have like any takes on or responses to that? To the video?
I mean, he was obviously more aggressive, not aggressive, but what they say hawkish. So he prefaced his speech by saying it's going to be short and to the point, which he doesn't usually do. He doesn't usually like. He tries to be kind of vague so that people don't make moves on his speech, but of course he wanted to be clear this time around. I don't know. I just thought it was very interesting. I mean, it's been very different from the way he's spoken before. So I think it has to do with Biden. I think Biden may be trying to ask him to get rid of the inflation faster, since obviously he has the midterms coming up, and he wants to make sure that inflation is taken care of during his term. So, and it may be part of the reason why he also forgave student loans, because you know a lot of these people who are being impacted by inflation, a lot of them probably have the student loans, and just giving them a bit of help on that front may make it a little bit better on his voter base. And but yeah, I mean, the markets reacted to it significantly. I mean, it was interesting that he didn't mention. Well, he did mention that the next time around that they increase rates, it probably will be like a historically high or a bigger than expected rise. So I think that was that, and the fact that he said forcefully, those kind of words triggered the market to sell off. So, so anyway, I mean, as long as we keep at it, I think that is a positive thing to try to get rid of inflation, because it does make the economic environment tough on companies and consumers. So
yeah, I mean, I thought it was kind of interesting that he referred to like the history of the central bank, or like the history of the philosophy on what the central bank is supposed to do. I think he mentioned that a while back people didn't really think that it was necessarily the central bank's role to fight inflation, but now we certainly do think that way in our modern economy. And since like he believes that the central bank has like, not only like the authority but just like the responsibility to combat inflation, he's going to use like the weapons at his disposal, which is going to mean raising interest rates.
Yeah,
and
I mean,
we could see something like another 75 basis point increase come September.
Yeah, it was very interesting because, like I said, not only did he say forcefully, not only did he say higher than expected rate hike, but he also like allured to Paul Volcker, which, if you know anything about like the Fed, I mean, he was the guy who was brought in to bring like the 80s and 70s inflation down, and he actually caused like a crisis in the economy, but he wanted to make sure that inflation was gone. So 15%, 17% inflation, that's when he came in, and ever since. But Paul Volcker was like it was pretty much ruthless against inflation, but it was just so many like words that he used that just signaled that he was going to be really aggressive with inflation, and so the market was spooked with good reason, and then it was just a weird, very unlike his other speeches. I mean, that's why I think it has to do with policy, because I mean, it feels like he was very had a different tone to the way he approached his speech than even in the previous latest speech that he had. So very interesting one for sure.
Yeah, I mean, I think one good part of like the speech was just like that he mentioned that the economic tools we do have at our disposal like are working. Like inflation like has been improving, like just due to the rising like yields, but still there's a lot of work to be done. And he does in fact predict pain in the future for the participants in the economy. But regardless, I think it's just crucial just to not panic too much and just try to keep like a long-term focus anyway. Because like, even though in the short term we might be headed for a recession, I think like investing consistently is a solid way of improving your portfolio, because in the long term, all of the short-term instabilities will even out. And of course, as we always say, staying long and staying green is a great way to invest. So for all of you out there, stay long, stay green, and stay positive, even as times get tough.
What's up, everybody? Thanks for watching Wall Street Saturday. Remember, this is for educational purposes. We're not financial advisors. If you like our videos, go ahead and like and subscribe and hit that notification bell to be notified every time we have a new video out. Thanks for watching.